Do you want to buy another home, but you've got a home to sell and your down payment is stuck in the old house? You go to try to make offers on properties, but sellers are not biting on this type of offer that is contingent on the sale of a home, and they don't want to have to wait until your house sells. So how does this work? How can you buy another home before your current home is sold, and you can still get your money from your current house as a down payment? I want you to think of this as an advance against your equity. You're going to borrow money that is secured by your current home in order to use to purchase your next home through something called bridge financing. I've got 3 unique ideas about how you can borrow money now to go buy another home without having sold your current one. And then once your house is sold, you're going to pay off the loans that I'm talking about. Hey, I'm Peter Lindquist. I've been a mortgage lender in Minnesota for over 30 years, and I'm going to share some of that experience with you today. Okay, so you're expecting some money from the sale of your house, but you don't have it because your house isn't sold. How can we borrow money to use as the down payment on your new house? Think of this all as short-term solutions for this temporary problem in which you don't have your home sold. So the first one takes a little bit of planning. You know, if you are thinking about buying a home next year, maybe it's 2027, one thing you can do is to talk to your bank about getting a home equity line of credit. So if you're not familiar with what those are, a home equity line of credit is commonly called a HELOC, and they are a second mortgage on your house. And think of it like a big credit card that is secured by your house. So you can borrow against it, pay it off, borrow against it. You don't have to borrow all or any of the money right away, but that line of credit is available to you when you need it. In order to get a line of credit, you're going to need some equity in your home, but you've got a house, and let's assume for the moment that it's worth $400,000 and you owe $300,000. So you've got equity in the property, roughly 25% equity in the property. Now, the way a home equity line of credit works is they're going to calculate a percentage of that remaining equity to determine how much the bank or credit union is willing to lend you. The guidelines for these is all over the map. So sometimes it takes a bit of shopping around. For example, they might say, we can open a home equity line of credit up to 80% of the value of your home. Well, 80% of the value of $400,000 is $320,000. If you already owe $300,000, that just leaves you $20,000. So with that, it's not really helping you the way that you will want in order to accomplish this end goal. Other banks will go up to 85%, 90%, and even 95% is not unheard of in today's market. So let's use 90% as an example. 90% of 400,000 is 360,000. So you remember, you owe 300,000, the bank will go up to 360. That means that they'll do a home equity line of credit up to about $60,000. So now on your old house, you'll owe 300 plus if you borrow the maximum from the HELOC, that's another 60. So you owe 360, you have $40,000 left. When you sell your home, you're going to need to pay off both loans. So with this idea, you open up this line of credit, you don't borrow any money yet. But when it comes time to buy, now you draw off of that line of credit. I want to be clear that this needs to be done well ahead of time. If this is just a notion because you saw a house this weekend and you want to go buy it, you're not going to be able to accomplish this because the bank is going to want to know what you're going to do with that line of credit. And if you get it far enough ahead of time, who knows, you might never move. So your plans are not as certain as once you've found a house and now you're going to make an offer on a property. That's one reason. The second reason is that with a home equity line of credit, they will typically have a prepayment penalty, and that can vary on how much you owe on it, but it's not atypical to spend $500 to $800 because you opened up a line of credit and you closed it 6 months later. So if this is something you're thinking of 3 years from now, that's where it's really ideal, because then you may not even have to pay that prepayment penalty. But if this is something you're thinking about doing this fall, this is a great option. Now, as good as that sounds, most of us don't prepare that well. And so that's option one. Option two is something called a bridge loan. And it actually works very similar, but with a bridge loan, everyone is aware that you're putting a very short-term line of credit on your house that you're going to draw from to buy another one. This is the one where if you found the house this past weekend, this is what we're going to use. So with a bridge loan, you're borrowing against the equity to go purchase a new one. And again, different banks and credit unions will have different guidelines as to how far they'll go up. This is a risky loan for a financial institution. We work with a few of the credit unions and banks in the Twin Cities area that have specialized in these, and they understand how to do them. They understand the risks. And with that being said, you're going to pay some cost when it comes to these lines of credit. It's not super expensive, but it's something we're going to have to factor in. But they have to charge costs because they're not going to make money on interest. Understand this. They will close this line of credit and it might be paid off 2 weeks later, when you sell your house. So the financial institution that's doing the bridge loan for you is not going to swallow any of the costs they need to charge you. So it's common, again, that they might go up to 90%. You can get up to $60,000 from that line of credit to use towards your down payment. So it's not all of the money that you would be getting from the sale of your home, but it can be most of the money. The nice thing with bridge loans is that the payments they require are interest only. And that means that they are, by and large, smaller monthly payments. So you do make monthly payments. After you borrow the money, you're going to make interest-only payments once a month until you've sold your house and paid off that, along with any other mortgage you've got on the property. Then there's the third option, and this one is actually probably the most common, and that is arranging other types of financing to be your bridge loan. And sometimes this is putting a few different types of financing together. Remember I said on the home equity line of credit that you get $60,000, but maybe you need $70,000 to go buy the new home. You still have that equity left over in your house. Well, how do you come up with the extra $10,000? That folds right into this same argument. If you have a 401k through your employer and that 401k has a substantial amount on it, those typically have a method by which you can borrow against that money up to 50% of the value. So you have $120,000 in your 401k, you can borrow up to 50% of the value, not to exceed $50,000. And I also like to make sure to tell you, you should talk to your financial advisor before you do anything like this. But in general, what I've been hearing from customers is that there's no closing costs and there's no tax penalty and there's no penalties for withdrawal. When you're borrowing against the 401k, it's very different from cashing in your 401k. And, if it's a short-term solution, you need the money for 2 weeks, it can be the lowest cost way in order to accomplish this method. But there's other interesting ways to get it too. Did you know that if you have equity in a car, if you qualify, you can get a loan that is secured by that car? Let's say, for example, it's worth $30,000 and you have a loan on it right now for $5,000. Well, banks will often go up to 100% of the value of your car. So in that case, they could replace that car loan that you've got, make a $30,000 loan, pay off the $5,000 that you currently owe, and now you've got $25,000 left over. This one, you also need to be aware the payment is going to be more substantial on it. We do need to count that payment on your income to debt ratios, but it's another low cost solution. And then there's also just plain old gift money. If you've got a family that has money to gift you and help you along in this transaction, obviously, that's another place to source your funds. We talked about 3 different ways in order to access your down payment funds before you've sold your house. There's planning for it and getting a traditional home equity line of credit, looking for a bank that will give you as much as possible, ideally up to 95% or even 100% of the value of your home. And that line of credit is just going to sit there until you need the money and then you can draw from it. Second one is a bridge loan, and those come with all their own parameters, but bridge loan is kind of most common when you've got equity in a property and you've found a house already and you need to make this happen pronto. And then the third one is a variety of loans, and most common that I can think of is going to be 401k and bridge loans. And with any of these, they're all short term. So once your house is sold, the idea with these is that you'll go ahead and pay these off. If you've got any questions, my name's Peter Lindquist. I look forward to hearing from you.